So if your chart is looking like a Christmas tree and has too many indicators, you're probably missing out on the real story that's being told by the instrument. So this series on price action trading is going to bring us all back to the basics. We're going to emphasize that all the information that you really need is showing up in the raw price movement. Now, the core of price action, it just lies in its simplicity. The market participants' decisions, the buying, the selling, these are all reflected directly in the price movements. So our goal is always to read and interpret these movements without the distraction of complex indicators. So when we focus on the quote naked charts, we are engaging directly with the market's behavior. So this is going to allow us to observe and react to the price itself, which is the most immediate and accurate indicator of what's happening in the market, the instrument you're trading. Price action, it gives us clues about market sentiment. So each candlestick, each movement has a story to tell us about the balance between buyers and sellers. Understanding this balance can help us predict where that market is likely to go next, the probabilities. Candlestick charts, these are particularly revealing when it comes to price action analysis. So each candlestick represents a specific time period. It provides 4 key pieces of information: the opening price, the closing price, the highest price, and the lowest price that has happened. The shape, the size, and the color of these candlesticks offers insights into the psychology behind traders' behavior. For example, long green candle, this is going to suggest that there's some strong buying pressure, right? A long red one, it's going to indicate strong selling pressure. Buyers are feeling good, and the showing of strong buying can bring others into the instrument. The opposite's true. Long, red, bearish candles can entice selling and those going short. And then we have those doji candles. This is where the opening and the closing price are pretty close. That means there's some indecision in the market or an equilibrium, right? Traders are just a little bit hesitant about taking bigger risk. So the buying pressure, the long lower shadow, indicates strong buying pressure that overcame initial selling pressure. The buyers were able to push that price back up significantly from the period's low. Then you have a rejection of the lower prices, and this shows that the market rejected lower prices. And what does this mean? That there's potential support at those levels. People will defend them. So this pattern generally bullish, especially if it occurs during a downtrend or at a support level. That could indicate potential reversal or just the end of a downtrend. Longer the lower shadow, the more selling pressure was absorbed by the buyers. It indicates their strength. Now, context matters, right? The significance of the pattern can be improved if it occurs at a key support level or after a prolonged downtrend or with increased volume or at the end of a massive consolidation. You also want to consider market structure. This is just the pattern of higher highs and lows or lower highs and lower lows and the trends that connect them. So an uptrend, we all know, we see rising highs, rising lows. A downtrend features the opposite, falling highs and falling lows. So when you can observe these patterns, it helps us anticipate future movements. Now, we're not always going to be right, but we're not always going to be wrong. That's how we make money. Consolidation periods, this is where the market just goes sideways. This often precedes significant breakouts depending on how long it consolidates. This pause in trending price action is typical behavior. And inside that consolidation, there's buying and selling, just that levels aren't really pushing the instrument in either direction. So on your chart, to keep things very simple, as soon as price stops making the trending structure, consider that we're looking at the beginning of a consolidation. So a higher high followed by a higher low, and then a lower high, it's a sign that we want to start paying attention. And then recognizing these patterns, and then the subsequent breakouts, this can lead to profitable opportunities to trade. A true understanding of price action, this involves recognizing these structures and knowing when a trend is gaining or losing strength. This knowledge, this empowers you to make decisions that are based on the realities of the market. And we're going to cover patterns that price makes in another video when we talk about chart patterns. So in short, adopt a less is more approach, right? When you do that, you could cut through the noise and you focus on what really matters, the price itself. This straightforward approach, it not only simplifies the decisions that you're going to make when you're trading, but actually improves them because it grounds them in the actual dynamics of the market. So in our next video, we're going to dig into market structure and how to use it to supercharge your trading.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.